Good to go.
All right. Hi, everybody. I know a few of you are getting signed in right now, so thanks for joining us. We'll give people a minute or two here to get signed in and start out with all the pleasantries of our beginning. But thanks for joining us today. We're going to be talking about managing equity awards, which is always a hot topic in our world anyway. We work with a lot of high-tech clients, and many of them work for big tech companies. And a lot of their compensation ends up being in the form of restricted stock or options or some other types of equity awards. So as people are getting signed in here, a couple of things I'll mention. Number one, we always want to make sure that you know that these are just our opinions from Jeremy and I. We talk about a lot of different stuff here, but those are just opinions, not recommendations. And of course, we are not giving you financial, legal, tax, or other advice. Finally, we don't guarantee anything in our industry. We can't guarantee anything. We can't even guarantee what's going to happen by the end of the day, right? So that's something that you should just know about when you're visiting with us, is that we're giving you our opinions, and that's what you would expect from a fiduciary, which is what we are. So as everybody's getting signed in here, we'll let people kind of pop in, but quick introduction. For myself, Josh Nelson, I'm a certified financial planner and the founder and CEO of Keystone Financial Services. And with me today is Jeremy Busch, also a certified financial planner and wealth advisor. And between the two of us and our wonderful team of folks, we take care of people's money and their investments and their financial planning. It's really our job to help navigate the waters, especially right now when things are really uncertain. So glad you are here today. We'll go ahead and get started with a couple of things. Number one, we want to talk about some technology stuff. When it comes to the presentation that you're on right now, if you've got the ability to ask a question, please do, because we like that. We like to have this be interactive. And if you are watching this after the fact, then that's great too. And to just know that we are here, we want to be here to support you more than anything. So just let us know, communications@keystonefinancial.com. If there's ever any questions, you can also just go to our website, keystonefinancial.com. We try to make a lot of things available. In other words, to communicate with us and get answers to your questions, even if you're not a client. We just throw that out to you, that we want to be here and be supportive. And certainly we hope that there's an opportunity for us to do business down the road. So with that, let's go ahead and get started. First of all, equity awards. So let's talk about what they are. And, I've been in this industry for 22 years, 23 years, something like that now. And almost all of that has primarily been working for people that work for big companies, many of them tech companies. And that's a significant thing that many of these companies offer is equity awards. And the reason why companies do this is it's another way to provide an incentive for their employees and a lot more buy-in, right? If the company stock does well, if the company does well, then everybody's participating in that. So for the employee, certainly it can be a wealth creation tool. We've seen that on a number of occasions. People that sometimes are quite young, could be in their 20s, maybe early 30s, and they end up with a lot of money early on simply because the equity awards that their company was offering and the company's stock went way up. And so it ended up causing them to get a value creation, as far as their wealth, a lot of value creation in a very short amount of time. It's also a way to participate in your company's success, of course, and being an owner. When you own stock, that's just being an owner of the company. Even if you just own one share of stock, that actually makes you a part owner. And what we're probably talking about here is being an employee of a publicly traded company. Most of the time, that's what you would see. It's not to say that private companies can't do things like that. There are different types of equity awards that private companies can do. And of course, in the last few days, we've been hearing about Twitter becoming private companies. So it'll be interesting to see how that all unfolds. And sometimes private companies go public. So oftentimes people, if they're working for these companies, they end up being caught in these transitions. And sometimes that can create a lot of stress, but it also can create a lot of opportunity for people who are getting those equity awards. And then exposure to the stock market in your company's sector. If it's a publicly traded company, of course, you're gaining exposure for better or worse, right? You're getting exposure to the stock market and growth, hopefully over time in that company's sector. So it may be that your particular company kind of goes up when the rest of the industry goes up. Sometimes it goes down with everything else. In other words, you might work for the best company in the world, even a company that's extremely profitable, very successful, and your stock still can go down when you're in a market like the one that we're in right now. We're actually in the midst of a market correction, and we may be in this for a while. We may be in some up and down activity for a while. So keep in mind that that's just part of the game. Sometimes you could own a great stock and the stock still goes down, at least temporarily. So equity awards do present some challenges because the stock market is kind of like turbulence. If you fly in an airplane, at some point it's going to get turbulent, and especially if it's a long flight and if it goes over the ocean or something like that, you never know. It could be really turbulent. In fact, so we live here in Colorado. Denver is known as one of the most turbulent landings throughout the year. Almost always you're going to get turbulence when you land in Denver. That's just part of the deal. If you're going to fly into Denver, you just accept that as part of the risk, part of the discomfort that you're going to be experiencing. Now, the other part of it too, of course, is golden handcuffs. And from a company standpoint, this works out really well because if the company's stock is significant in value and it's gone up, these things have vesting periods. And Jeremy is going to get into this in more detail in a few minutes. But one thing to keep in mind is that the golden handcuffs, what that means basically is that because there are vesting periods, you might be leaving a lot of money on the table. Say if you left today to go to a different company or to retire, we've seen this happen all the time with our clients in that people want to retire, but sometimes it's so expensive, right? Because you're leaving so much stock or options on the table, you might actually lose that value. In other words, by leaving early. Companies know this, of course, and so that's why they do it, because it makes it expensive to leave and it makes it very attractive to stay, especially if that company's stock is doing really well. And of course, individual company risk, we'll talk about that. Don't keeping all your eggs in one basket. We've all heard that, right, from our dad or our mom or our grandma or somebody, right? Somebody said that when we were growing up, is don't put all your eggs in one basket. And really that principle holds true with investing, simply because even if you work for the best company in the world, sometimes things change, right? So you look at the list of companies here that we've put on here, and certainly we could brainstorm and have some fun as far as thinking of different companies, ones that were once great companies, and now they don't even exist. And that's what you're seeing on the screen here is companies that don't even exist anymore. Many companies also can just go down a lot, like Netflix, for example. If we kind of look at that last example, Blockbuster Video, kind of an interesting story. Blockbuster, you may have heard this before, but Blockbuster Video actually had the ability back in the year, I think it was 2000 or 2001, they could have bought Netflix for $50 million back then. And the CEO actually, the founders of Netflix actually pitched to the CEO of Blockbuster and said, hey, we've got financial trouble here, basically, but we've got great technology, a great concept, and we'll let you buy us out for $50 million. They got laughed out of the boardroom. And of course, the rest is history. And that Blockbuster didn't believe in that business model. They thought that people were always going to want to go to a store, right? It's laughable now, but people were actually going to want to go to a location to rent their stuff. Now, of course, everything is streaming and Blockbuster doesn't exist anymore. In fact, I think the last Blockbuster Video closed down not that long ago. I think I saw that in the news. So just know that even if you work for the best company in the world, it may not always be the best company in the world. There's also stuff that can happen. Look at other examples on here like Enron or WorldCom. Those actually were really well-respected, huge companies, global companies, and had long-term employees. Many of them had held the stock for years and years and years. And sometimes that can lull people into thinking the false belief that this thing can't go down or it can't go to zero, or it always comes back, because I've owned it for 20 years and every time it goes down, it comes back and it goes higher. Well, not always, right? So there's all kinds of stuff that can happen. In the case of Enron and WorldCom, it was outright fraud. There were people that were cooking the books in the back room and nobody knew that. Even the best employees, the most seasoned employees there had no idea that this was happening. So recognize that this is not a diss on anybody's particular company, right? It's just a matter of diversification and spreading out that risk. So let's talk about the market a little bit. Again, it's a little bit turbulent right now. And this is kind of funny. You've probably seen things like this in the past, but when you look at the cycle of market emotions, it's a little bit different than a stock market cycle or an economic cycle. These are the feelings that people have when the market's going up or down. And certainly you can apply this to an individual company stock as well, right? And that when things are going great, which many companies, they were at their all-time highs not that long ago. And so people may have been up at the euphoria or the wow, am I so smart emotions. And then, of course, when things start to pull back, and Netflix is a good example here recently, is the stock has pulled back substantially. some changes in their business model, certainly, and a lot more competition out there. At least it used to be that Netflix was kind of the only streaming platform out there, and now there are a lot of them. And a lot of people were actually jumping off of that platform and on different ones. So they may be able to reinvent themselves, and sometimes that happens, is that companies can reinvent themselves and come back. And other companies are ending up like Blockbuster, and that they just can't change fast enough or not willing to change fast enough. So where do you think we are here right now? Probably not euphoria, right? We're in a market correction. Things have pulled back some. My guess is we're probably in that anxiety, denial, fear on that downward slope right now. Well, I don't think we're at desperation and panic. Maybe certain stocks you might feel that way, but the overall stock market, we're definitely not at desperation, panic, capitulation, despondency. People would feel a lot worse about their stuff right now. And that's actually a good sign of a market bottom when we look at it historically, is that people have almost given up. In some cases, people do, sadly. And oftentimes that is when, if people capitulate, which means they give up, right? They say, all right, I'm out. They jump off the ledge. There's no way to come back from them. And so that's one thing, just to know the level of risk that you're taking in your portfolio. And in our client meetings, Jeremy and I talk about this a lot with people as far as the risk level that they're taking in their portfolio. And our experience is that nobody really knows how much risk that they're taking. Very few people actually have any idea how much risk is in their portfolio. So we spend a lot of time talking about that, because making money in the market is easy when things are just going up. If you just stay diversified, stay in, everybody's making money. And really over the last couple of decades, that's actually been fairly easy, really since the financial crisis. For the most part, things have just gone up. And so it wasn't that big of a deal. Now we might be going into a time period where things end up going down. And they might actually go down to the point where we end up in that capitulation, despondency area. Nobody knows. So we're not trying to make a call on the market or tell you to go out and time the market, but just recognize that good times only last for so long, and bad times only last for so long. And the story of market history is just the story of modern economic history. And that as things continue to improve, people tend to come up with different ideas and get more efficient and so forth. So that really is our view, is that over the long run, we're very optimistic, but short term, we need to be aware of the risks and to make sure that you can actually live with that, you as an individual. So with that, I'm going to pass it over to Jeremy here. We're going to talk about some individual company stuff, right? This is not talking about the overall stock market. This is about the mechanics of different equity awards.
Absolutely. So I would say probably easily the biggest ones that we see are RSUs, or restricted stock units, as far as equity awards. Definitely the most common. You can see they have, everything we talked about has some kind of grant date, exercise date. These ones have a vesting period, which we'll kind of get into here. And the nice thing about these is most companies, now not all, they basically become taxed when they become unrestricted. So as they vest, they become taxable. And most of the time what we see is the employer will withhold the taxes. And so the nice thing is about that is you're not surprised by taxes. Nobody likes tax surprises, obviously, but always a good thing to check with. So if we go to the next slide, we can actually see, so kind of an example here. You can see on the bottom, you have basically three points in time. That's kind of universal for all options of some point. They all just kind of act a little bit differently. So if we say on January 1, 2020, that you were granted 1,000 shares of RSUs and they had a 4-year vesting schedule, basically what that means is that every year, starting 1 year out from that grant date, you get about 1/4 of those shares. So 250 shares would vest, right? Now, as soon as those vest, they become ordinary income to you, the owner. And so usually what we'll see is that instead of giving you the full 250 shares, your employer would typically withhold a few of the shares to cover taxes, what they see based on taxes for you. They use those to pay the taxes, basically send that to the IRS, and you get the remaining shares. So in our example here, instead of the 250, you get the 235 shares. Now you have an option at this point. You can immediately sell those shares at the current market price. no harm done. You get your money and you take it and you run. Or you can hold on to that stock and basically wait for it to, if you think it's going to grow, great. The idea being then is that as long as you hold it, you'd want to make sure that you hold it for at least 366 days. So 1 year and 1 day. And that gets you long-term capital gains on those shares. If you sell it before the 366 days, then you're subject to short-term capital gains rates, which is basically just your highest level of income, whatever your marginal tax bracket is at that point. So mostly what we see here in large part is that companies will get these, they vest on a number of year schedule, 4 to 5 years, something of that. That can be different depending on the company. But then each year as those vest, typically the employer will withhold some shares to pay taxes for you, and then the shares are yours to do with as you please.
Yeah, so a couple of points on that. One of those, the tax withholding, keep in mind that your employer has a certain percentage that they're taking out. In other words, they'll get rid of some shares, right? And then that'll pay the taxes. So keep that in mind, that that's just what they're withholding, may not actually be what you owe. You might get a refund. You might actually have to pay more in. So it depends on your individual circumstances. But in theory, though, basically what you're saying, Jeremy, is that if somebody, let's say I had some RSUs and they vested today, my company then would sell some shares. In theory, if I were to turn around right away, I wouldn't have any further tax liability. In other words, unless there had been some appreciation.
Exactly. It's the appreciation difference between that best price and the sale price. So if the shares go up from the date that it vests, then you'll have a capital gain situation. If that's share value goes down from the point of that vesting price, that vesting date, then you would have a capital loss situation. So it just kind of depends. A lot of what we'll see though is that you can make an election on vesting day that says vest and sell them all, you do my regular withholding, and then the company will do that. And then that way you're basically just going at parity, right? You have your vesting date price is the same price as your sale price. So there is no capital gains at that moment.
Mm-hmm. So for that reason, especially for our clients that tend to get more awards over time, sometimes people get an award, maybe it's just because they joined a company. It could have been some type of a recruiting bonus, for example, to switch from one company to the other. And then maybe they won't ever get any more awards. Sometimes that happens. But oftentimes what we're finding is that our clients that work for these companies, they'll end up getting more and more RSUs over time. So they'll continue to get new awards. So it's just one thing to think about. We're not recommending anything here, but one thing that sometimes we can be victims of our own success if we just continue to accumulate and never sell. Sometimes that can put a lot of risk on the table. Just that one company's stock, clearly, no matter who's running it, no matter how successful or profitable it is right now, that can change pretty darn quick. So keep that in mind, that taking money off the table may not be a bad thing. And of course, we can talk about what to do with that money, right? Once you convert it to cash, there's all kinds of things depending on your own situation. Maybe it's paying off debt. Maybe we just don't have a lot in cash and we need to build that up some. Maybe it's just strictly diversifying it because we just don't want it in one company's stock where we do have all our eggs in one basket.
Absolutely. Yeah, absolutely. So the next one that we would look at is what's called a non-qualified stock option. So this one is probably the next common, I would say, next to RSUs. No real tax advantages here to exercising and holding. Really, it's considered about 100% ordinary income to you. That is upon exercise. And this gets reported on your W-2 as income. So if we go to the next slide here, this is a really good one here for kind of explaining the different parts of it, right? So you have a grant price and a grant date. You have an exercise price and an exercise date. Now, the difference between the prices between those two dates is what's called a bargain element. Now, depending on the stock option, that bargain element is going to get treated a little bit differently as far as taxes go. Now, the most simple way is what we're looking at here is a non-qualified stock option, an NQSO or an NSO. They go by a couple different names, but they all mean about the same thing. So Really what it is when that option gets exercised, the bargain element portion of that is typically considered just ordinary income to you. So if it was at $5 granted and exercise price is $10, $5 per share is basically considered income tax to you. Okay. Now, if you, again, just like with the RSUs, as soon as you exercise it and it's a share, you can sell it right there and typically realize parity. And so there's no capital gain or loss situation. If you choose to hold it, same thing. You're going to want to hold it at least 366 days, so a year and a day. And you can recognize that long-term capital gain rate, which is typically lower for most people, just a flat 15%. If you're in a really high income level, it could be up to 20% right now as of this recording. But most people I think that we deal with are typically in that 15% range. Otherwise, if it's less than 366 days and you're at that short-term capital gain rate, again, that's whatever your marginal tax rate is at. So if you're in the 28% tax bracket, you're paying 28%, right? But really the kind of key with this one is this is probably the least amount of tax benefit here. Whenever it does exercise, that bargain element is immediately considered regular income to you. Nothing you can do about that. It's just how the option goes.
Yep. And I think a lot of people for that reason do what we call a cashless exercise. It can be talked about in different terms, but a cashless exercise basically is the person who says, you know what, I don't want to send anybody any money to buy the stock. I just want to buy it and sell it immediately. And most employers will have a way to facilitate that. They'll probably work with a big company like Fidelity or Merrill Lynch or something like that. And they'll facilitate that where it's kind of instantaneous. In other words, to buy and to sell, taxes are withheld, and then you get the difference. So, the other part of it too is that when you think about a stock option versus an RSU is something you actually get shares. With stock options, it's just the option to exercise. So that doesn't mean you have to exercise. And in some cases, you need to be careful about this because these do have expiration dates. And we've seen that happen before where people weren't keeping track of their stuff and they actually let some options not exercise. They actually let some options expire that were actually worth something. So they definitely left some money on the table, and stock options do have an expiration date. So you will lose them. You definitely will lose them if you had not exercised before that went out. So be aware of that. The other type of exercise will be that you're actually providing cash to cover the purchase of the stock. Yeah, that means you're sending them money. In other words, you're actually taking some of your cash, you're going out buying the shares, and then you're holding on to it. That's not as attractive in this situation simply because you're not gaining any tax advantage to do that. You're not gaining any pricing advantage because you could go out, open your own brokerage account and buy the stock for the same price that they're offering it to you. So really, there's not a lot of advantage on these. For that reason, we do see a lot of people do the cashless exercise.
Absolutely. Yep. So really then the next one, now these ones aren't as I would say common, but they do still exist. We run across them from time to time. So an ISO or an incentive stock option, these are probably the most tax advantageous, but there are some specific rules around how these get treated. And so really the key rate is, or the key rules on these are time, right? And so there's two measurements of time, and you have to meet both of them in order to get the best tax treatment on incentive stock options. So really the two dates to keep in mind is the grant date, and you have to basically hang on to these for 2 years from the grant date, and then 1 year from the exercise date. And so if you meet both of those dates before you sell anything, then you get to basically treat both elements, that bargain element up front and the capital gains element, as a long-term capital gain. Now, the thing to keep in mind with these is that during this time frame, when things do get exercised and you're waiting for that additional year, there are alternative minimum tax or AMT implications that we have to take into account. All right, so if we jump to the next screen on this, basically what we can see is, I like to look at stock options on a timeline. I think it makes more sense to me. So again, you have those three key dates, right? Grant, exercise, and sale. And then you have prices associated with each of those. And so on that first part there, you have that bargain element between grant and exercise. Now, when you exercise an ISO, the bargain element, or basically the difference between price of grant price and exercise price, is subject to alternative minimum tax. Now, what that basically says is, just like an NSO, is that they're going to say this amount right here, if you're subject to AMT, is going to be considered as ordinary income to you. Okay. So that basically means that you're on the hook. If you're subject to AMT, you're on the hook for that amount for taxes for that year. Now, when you meet the second part of that, that you go from one more year past exercise until you sell it, then you actually end up getting a credit for that AMT charge that you get, and everything gets charged at long-term capital gains. So it's a little bit of a dance as far as the taxes are considered here, but by far you definitely get a lot more benefit by hanging on to them for both of those time periods to get the best treatment out of it. So I believe we actually have some, let's see here. Yep. So if we look at, let's say, a disqualifying event, so that means we're not meeting timelines here. So basically the bargain element, again, like we just said, gets included as ordinary income taxes, and then capital gains. So in this element, we're saying, okay, there was 1 year from grant to exercise. So we're still subject to that. But before we met that second year time frame, somewhere between there, we had a sale, right? And in that sale, that basically means, okay, that ordinary income tax rate, that bargain element, gets treated just like a non-qualified stock option. You're at ordinary income tax. And then the capital gains portion is treated as that short-term and long-term portion, right? Okay. So it's very easy if you don't meet both that 2 year and 1 year time frame on ISOs. They pretty quickly resemble an NSO, or a non-qualified option. All right. On the next page, if we look at meeting the timeline, so obviously you can see a lot more going on this slide, right?
Yeah, I
This
think
is,
everybody's brains just exploded.
yeah, this is where, okay, we need to make sure we're hitting
Let's
these
try this at
timeframes.
home.
Absolutely. So you can see, again, we always use just a January element here, just kind of to use a calendar year as a good time frame. So we get the grant on January 1, 2020. Grant price is $5 per share. Non-taxable event to you in 2020. Nothing you can do about that until actually exercise. Okay. So then we hold it for a year and a day. So then our exercise is on January 2nd, 2021. Let's say now the share price is at $10 per share. So now we have that bargain element, $10 per share minus 5. So that's $5 a share is the bargain element. If we say now the owner is subject to AMT on that $5 per share in 2021. So if we had 1,000 shares at 10 and at that $5 bargain element, that's basically $5,000 that we are on the hook for as alternative minimum tax in 2021. Okay. Now we're going to hold it another year. So if we don't sell that until on or after January 3rd of 2022, then we have met all the timeframes. So we have a qualifying event in incentive stock options. So let's say now on January 3rd, 2022, we have $15 per share. So it's been going up pretty nice. So now all of a sudden that bargain element of that $5 that we paid back in 2021, well, the IRS sees it and they say, hey, you met all your timeframes, you're good here. We're going to go ahead and give you that $5,000 that you paid as AMT in 2021 as a credit towards your taxes this year. Okay. So now it just becomes great. We got that back. So now everything is subject to long-term capital gains rates because we've held on to it for more than a year. So now we have to go back to that grant price and say that was at $5. Now it's at 15. So now we're at $10 per share. Now that $10 per share, if we sold everything, is going to be at long-term capital gains rate for most people would be that flat 15%. Okay. So you can kind of see total taxes paid there between 2021 and 2022 is about $1,500 as long-term capital gains. All right. So this is kind of the best case scenario, right? Is we've held on to it. We went through all this. We took our licking with the AMT, but now we get the full benefit of the entire thing as long-term capital gains. All right. So you can see, yeah. And so in the inverse, so if we didn't, if we put some numbers kind of behind the not meeting timelines, if we met all the timelines, we got our best case scenario. Everything was taxed at long-term capital gains, and we ended up paying $1,500 overall. But if we have a disqualifying event, you can see there in 2020 as the shares. So we exercised the shares in December of 2020, as opposed to waiting another month for that to happen. That automatically disqualifies everything, and now that's considered ordinary income. So that original $5,000 is, instead of being taxed at AMT or at or whatnot, is at your regular rate. Let's say you're in the 24% tax bracket. That's $1,200, and you don't get that as a tax credit in the next year when you go to sell. So then say, hey, there's a sell that happens again in the next year. Again, now we're at $15 a share. So now we have $5,000 at that 15% rate. Sure, that gets long-term capital gains, fabulous. But overall, you can see the difference being paid there of just making sure you meet your timelines. The difference in this, very simple, is a difference of about $450, or the difference between $1,950 being paid in taxes or $1,500 being paid in taxes. So very important to kind of pay attention to dates if ISOs, if you have anything to do with ISOs.
Yeah, and especially these dollar amounts are just examples. Of course, sometimes these dollar amounts have much larger amounts, right? They have zeros on the end, so it can get quite expensive for people who aren't keeping track of it closely. Or I think, the tax code is very complicated, but as long as you understand the rules of the game and use it to your advantage, that's the key. For people who don't understand, they end up making a lot of mistakes and they leave a lot of money on the table. So just be aware that if you have ISOs, if you have incentive stock options, there's special treatment with these guys. And a couple of things to just note, as Jeremy mentioned, RSUs, those are probably the most common. That's the most common of what we see these days that companies are offering. Non-qualified stock options would be number 2. ISOs would be number 3. ISOs typically would be for people in upper management, for executives, C-suite, things like that. So keep in mind that you might have them for whatever reason. You might have these, but you're probably in the upper tiers of the company to be getting ISOs. Normally, it's not something that just the average employee would be getting.
Yeah, absolutely. Yep.
Very for our favorite kind of option.
Right. Yeah. So just like Josh said a while back, this is an option. This is not a you must buy. This is an option that you have that says you can purchase these if you want to purchase these. So an underwater stock option is pretty much what you would think. It's when the exercise price of the option is less than the market price of what the stock is at right now. So typically, the bummer behind this is that exercising a stock option does not in and of itself create a tax loss. You have to also sell the stock in order to realize a tax loss. Okay. So you don't get any benefit from just exercising that. And in essence, you would be paying more for the stock than really ultimately it's worth. And so why really would you do that? Right. What does that make? If you're fishing for a tax loss, I suppose you could do that. I don't know if that makes the best sense or if that's the best way to go about it. Really about the only reason that you would potentially do this is if it is a privately held company. So the stock cannot be bought on the open market. And you absolutely believe that the stock is going to be worth more than what you're paying for it. That would be about the only reason to do it. Again, the chances of that are really happening. Now, we have seen them in the past, but typically when you're doing that, you get a discount with a stock option. And so for the option to typically be underwater at any point, given the discount, is pretty unlikely, but not unheard of.
Yeah, this might be an urban legend, but I've been around long enough, about 23 years as an advisor now. Many years ago, and this is before they had a lot of technology platforms and things, we had somebody that they were able to actually exercise an underwater stock option by mistake, because they thought, oh, these are going to expire. I need to do something. And this is back in the old days, right, where you actually had to fill something out by hand and fax it into the company. Well, that's what happened, is that it's not like today where the computer would warn you, don't do this, or it would stop you or something like that. Evidently, it did go through, and that person actually ended up paying more for the stock than what they could have just gone out and bought it for in the first place. So that did not help them. That was not beneficial, but it's important to recognize, just at a 30,000-foot level, what are these things, right? Is that they're a stock option? It's just a choice. And one thing just to know is that a lot of times stock options, especially in a bad market, or if your company hasn't done very well, stock options actually can expire and they're worthless. We saw this happen to a number of tech companies back in the late 90s, early 2000s, where people got options. And those options never ended up becoming worth anything, because years and years and years, and the company still hadn't recovered its price that it had lost in the dot-com crash. So just be aware of that, is that it's just an option. And that's another special risk, right, with these, is that versus owning stock, where you could kind of own something and hope it comes back over time, just buy and hold, in other words. With a stock option, because it has an expiration date, that's one thing to consider, is you don't want to back yourself into a corner and wait too long to exercise, because you might actually kind of be butting up against that expiration date. And it just so happens that your company's stock went down for some reason, and now they're worthless, or they're worth a lot less than what you could have gotten before. So just keep that in mind, is that there's a special risk, I think, with options, with those expiration dates. And again, it's just kind of a hypothetical value. Until you do something, you exercise those options, it's a hypothetical value. So just keep that in mind. It's one thing just to differentiate between stock options and actual shares of stock of what you would have.
Absolutely. So I think the last one that we're talking about today, and this is pretty popular nowadays, we see these a lot, is stock purchase plans. And so what this is, company stock is basically made available to those who work there. You typically get a bit of a discount on whatever the shares are worth at that time. And the nice thing is it's kind of automatic, right? It's like contributing to your 401k. You can set it up with your employer. Typically, there are limits to how much you can purchase, but you can say, I want 5% of my check to go towards the employee stock purchase plan. And every time you get paid, you get some stock, right, that comes out there. So unlike the 401k, of course, those contributions are made with after-tax dollars. So it's not like pre-tax. You don't get any tax benefit to that. The only bonus really is that these are taxed at the sale and not at the purchase. All right. So we have all the same elements to this. You have that bargain element, that grant price, exercise price, the fair market value of all this stuff. But the key with these is that there is no actual tax implication to you, the employee, until such time as you do the sale. There are some benefits to kind of hanging on to this, again, for capital gains purposes. There's some similarity to these, like ISOs, and the fact that if you hold them for a while, you actually get a little bit more benefit from a tax standpoint, depending on what that looks like from you. So as we look at these, again, the biggest part with this is you are really just kind of buying shares, right? And so I don't know that I've ever seen a stock purchase plan or a stock option plan that didn't have some kind of discount available to it. That's really the thing that makes this really look good to employees, is that they get to purchase the stock no matter where it's at, but they get an immediate discount on it. So you basically have some kind of built-in value to these stock options when you get them, right? So similar timeframes here. If you hold them 2 years after they're granted, basically, and 1 year after purchase, you get some long-term capital gains. But really, it's, as opposed to the option, you're not having the option to buy stock. You are, in essence, buying stock. So you have physical shares at a discount that you're getting with these that have kind of some immediate value. So these are kind of a nice one. It doesn't cost employers much of anything to allow employees to participate in something like this, other than the discount. That's really the only thing that employers are out of, is if it's a 5% discount or a 10% discount. That's the only thing that they are out on this, in the essence, hopes that It's going to keep employees around longer. It's an incentive to keep them working so that they get more shares. The longer they work, the more they get to participate in it. So really just a way to hold on to high value employees, or really any employees at that point. And so kind of overall, just a nice thing that's out there, but also something that has tax implications that you have to be aware of. Yeah. And so kind of examples on this, very similar, kind of going to that ISO's example, right? It works a lot the same. You have the bargain element, you have the capital gain element. If you hang on to them for the same amount of time, you get the long-term proportion, basically like 2 years. So you'd buy it, hang on to it for a couple years, and then you're able to sell it, and it's at that long-term capital gains rate. If you do sell it before then, obviously everything basically gets kept treated as ordinary income tax. So again, using very simple numbers here and very small numbers. 1,000 shares at $1 difference between these prices, between the bargain element and the capital gains. You could be looking, if you did a qualifying event, you'd be looking at about $390 worth of tax, versus if you don't meet the time frames and you just sell them out right away, you'd be looking at about $480 worth of tax. And so you can imagine if that discount is a little bit bigger, or the number of shares starts to multiply, how that amount of tax can really grow and grow pretty quick. Especially with, just like anything else, especially with employee stock purchase plans, you're buying in and you're buying in all the time. So now, instead of one date that you have to keep track of, you have, potentially 26 dates throughout the year if you get paid every other week, right? So every 2 weeks, you got 26 pay dates during the year and 26 buy-ins throughout the year. So when it comes to actually selling these, there's a lot of technology that helps us out today with these, whether they're custodied at Fidelity or TD or wherever, that will kind of help you say, well, this is your time frame on these options, or these shares and these shares and these shares. But it's just something that's best kept an eye on. You have to keep an eye on it. Otherwise, you could be causing yourself a little bit of a tax issue without really even thinking about it.
Absolutely. Yeah, the one thing to keep in mind is that on all these plans, these are very individualized based on individual companies. So we're giving you kind of the broad swath of how these things work, but each individual company is going to have differences as far as how they administer these plans. As Jeremy mentioned, the amount of discount that you might get on the stock purchase plan. And sometimes, of course, if a company is going through tough times, sometimes they'll pull that back. You might normally get a 15% discount and they pull it back to 5%, or they go to 0 in some cases. Same thing with company matching on retirement plans like 401ks. Oftentimes companies will suspend that in tough times because they're trying to find any way that they can to save money. So just keep in mind that it's important to understand the rules, and also just be cognizant of the fact that that plan can change over time. You want to just be aware of how your company's plan works so you're not surprised. You want to make sure that you're taking money off the table along the way. From a strategy standpoint, one thing to keep in mind is that if you're buying stock over time or getting more awards over time, then you're actually increasing your risk more and more and more as time goes on. So that's why there is some sell discipline, is what we call it, having the sell discipline as far as having the strategy of how am I actually unwinding this? How am I selling, knowing that I'm going to be accumulating more over here? Maybe I actually want a strategy for selling some over here so I don't end up accumulating too much and have too much risk on the table. So very, very important to understand all these rules. They're all good things, right? It's good to have these things if your employer is offering it, but it's important to understand the level of risk you're accumulating as well, especially if you're holding on to stuff. If you're holding on to it, that could present risks down the road if your company goes through a tough time. So.
Absolutely. And another thought on that too, Josh, is you just reminded me of a real life situation we had with a client. I think it was just last year, who had a bunch of RSUs. Another thing that can happen with this is, just like Josh was saying, companies can set these up a little bit differently with their own specific rules. So it's important to know those, or know somebody like us who can research that and understand what's different at each company. But this client in particular was working and reached the age of 65. And according to that company plan, when a employee has RSUs and reaches the age of 65, all of those shares automatically vest. And so all of those shares automatically became basically taxable to him at that time. And so it's something that you always have to keep in mind. There are, various dates. Josh mentioned expiration of stock options. Again, it's an option. You have the option to purchase stock. I have never seen a stock option that didn't have an expiration date. Typically what you see is about a 10-year window from either the grant date or the vest date. That can vary a little bit. But typically it's from the vest date at about 10 years. So if you don't, use those options or exercise those options, they can go away. So things to keep in mind, just little things that, you might easily lose track of if you're not paying attention to it. But these can be really, really great things to have. And you just want to make sure that you're using them to their full advantage and not paying more tax than you absolutely have to when the time comes.
Absolutely. And one other thing that comes to mind as far as timing too, is that we have a number of clients that if you're at a certain level within the company, or if you just know too much, I mean, basically that's what can happen, is that you might have quiet periods where you're restricted from selling stock, period. You just can't exercise anything, you can't sell anything. And so in some circumstances, we have clients that they can only sell during very limited windows throughout the year. So that's a special risk that you should be aware of. Yeah, again, I think even doubles down on my point before as far as having to sell discipline, having some way to get out over time, because things can change very quickly and often do. So, it's not to minimize it all, because we've had clients that have literally accumulated millions of dollars of wealth off of equity awards. That's predominantly, maybe in some cases, how their wealth was generated to begin with. So that can go away very quickly. We've seen that happen, lots of different companies, but also we've seen situations change too, where maybe somebody is forced into retirement early and they lose RSUs, things like that. There's all kinds of stuff that can happen. So very, very important to have a plan and have a planner. Tony Robbins once said, complexity is the enemy of execution. And as we just went through these slides, especially once your brain exploded, at the ISOs, it can get really complicated. And so what we find is that a lot of people just don't do anything because they're confused. They're just kind of putting it off, in other words, and saying, well, I'm not going to deal with this right now. It's just too much brain damage. And then they end up really leaving a lot of money on the table, or taking too much risk, or they just end up in this state of constant anxiety where they know that there's a problem. They know that they're not planning adequately, but they're just not in a position to do it yet because they're not a financial expert. And so that's where obviously our clients have chosen that I want to hire a fiduciary, I want to hire a financial expert. Another one, Sir Richard Branson, complexity is your enemy. Any fool can make something complicated. It is hard to make something simple. And so that's really our job at Keystone, is that we want to make the complex simple. You can see our page here has a lot of different stuff. These are a lot of different planning areas. I'd say most of the major planning areas that we handle with our clients. And it's something that doesn't just happen all at once, of course, because if you're 35 right now, you're probably not doing any Medicare planning for a while. You've got some time to go. If you're beyond age 65 and you're on Medicare, then you probably don't need to worry about health insurance anymore, maybe not as much, that your plan options may be different than what they were before. So as you go throughout your life, we want to be here to support you and your family members, your coworkers, certainly, because a lot of this stuff does get pretty darn complicated. And if you're not experienced, if you don't have exposure to this stuff, you can either become a financial expert, and if you want that to be your new hobby and spend hours and hours and hours of your week doing that, and some people do, some people think it's fun like us, but for a lot of people, they say, I've got a limited number of hours and I need to have somebody else that I can trust that can help me with this stuff. That's really why we're here. And certainly investment planning and employee benefit planning, tax planning, a lot of these columns, in other words, that we're looking at to fold right into equity awards. So whether that's something that you have right now or you get in the future, sometimes people get it in the future too. They sign on with the company and then they get a promotion, and all of a sudden, well, you have these new employee benefits available that you didn't have before. So keep that in mind, that these are really important things to be addressing, not only for right now, but also over time as you're planning for your own financial freedom, your own retirement. So, and of course, we have a team. We've got a team of great people that We used to support us. Jeremy and I are the lead advisors, certainly, but we've got 3 CFPs on staff, Peter being the third, and we've got a lot of other experienced professionals here day to day helping you do your planning. And certainly as things evolve over time, and it's not always good stuff. We've talked about equity awards. Equity awards are typically a good thing. It's a good problem to have. Sometimes bad stuff happens. People lose jobs, people get sick, people lose spouses. There's all kinds of stuff that we have the privilege, and sometimes it's hard, right? Emotionally, it's hard, but we have the privilege of walking along with people as they're going through major life transitions. So if that's you, even if it has nothing to do with equity awards, certainly we want to be here to support you. And really, our team is here because we care about our clients. We care about your story, and we care about really what you want your life to look like, and how money plays into it. So with that, Jeremy, do we have any questions in the queue? I want to be respectful of time.
Right. No, we don't have any questions as of yet. I wanted to give people a quick couple minutes here to throw something in that Q&A box if you do have any questions. Obviously we went over quite a bit. Tried to keep it as simple as we could, but still give everybody some good information here. But just like you can see, these things all get treated a little bit differently. They can get complicated pretty quick, but again, if we kind of break it down and take it step by step, we can still bring some simplicity to the complex situation. So please use that Q&A box. We'll leave it open for another minute here or so if you have anything. Otherwise, back to you, Josh.
Yeah, absolutely. Yeah, one thing to keep in mind too is that when you look at different companies' benefits, a lot of them work similar, but if you've changed companies, or maybe you have a friend who works for a different company, keep in mind there's nuances between all of the plans. So it's very important to read your plan documents to understand exactly how things work. And again, if it's something that you're not up for right now, or you just don't have time and you want to delegate that to somebody else, that could be us, that could be Keystone. And so certainly consider us in that, and just use us as a resource. Even if you're not a client right now, we always want to make ourselves available, especially if it's just answering quick questions, things like that, to support you. And then over time, it might actually make sense that you become a client, or at least look into how that would work. So a number of different things. If you go to our website, keystonefinancial.com, that has a lot of great information. It also has a risk survey. If you go down about 2/3 of that front page, there's a risk survey. And I mentioned that before, that we spend a lot of time on that with clients. And you can actually do an assessment, and less than 10 minutes. It's actually very quick. Less than 10 minutes, you can get an assessment of your current risk level that you're comfortable with. In other words, you'll get assigned a risk number. And that risk number, even if you don't do business with us, that's fine. Gives you an idea of what level of risk you're actually comfortable with. And especially in the midst of a market correction, of probably some more turbulent times, like it or not, we're probably going to have some kind of a recessionary or slowdown period going forward here, as the Federal Reserve is now tightening things up. A lot of uncertainty in the world. That doesn't mean that things aren't good long-term, right? Historically, we have recessions, we have bear markets, we have things that are kind of temporary setbacks, and sometimes those setbacks last for a while. So just be aware of that things are shifting right now. Things are shifting from times where money was fairly easy until times where it's going to be harder to make money. Maybe we're wrong. Maybe everything will be great and there won't be any tough times ahead. But I think we're pretty spot on there. We pay a little attention to a lot of different experts that watch the markets, that certainly watch economics and watch Fed policy as far as how this is going to play out. So we do want to make sure that you're plugged in. You can use resources like this, like our webinar. We have a YouTube channel. Just go to keystonefinancial.com. Lots of different resources, podcast, webinars, lots of different ways that you can stay plugged in with us and continue learning. Anything else, Jeremy? Any questions that came up?
No other questions, and I believe we are at time. So I just want to say thank you to everybody for attending, and let us know if there are any questions outside of it.
Absolutely. Yep. Have a great week, everybody. Thank you. Take care.